Right now, Wall Street is quietly executing the largest financial migration in modern history. Over $1 trillion in private credit and venture capital is being poured into a singular bet: autonomous artificial intelligence. But behind the historic mega IPOs and $2 trillion valuations lies a terrifying mathematical reality. The physical infrastructure required to run these systems is burning through cash faster than these companies can generate it. The AI boom isn't just a tech revolution, it has become a debt trap. And the structural plumbing of the global stock market guarantees that Wall Street's ultimate exit strategy is your retirement. To understand the trap, you have to look at what just happened on June 12, 2026. SpaceX, carrying its internal AI subsidiary xAI, went public in the largest initial public offering in financial history. Within 24 hours, the public markets valued the company at over $2 trillion. For the mainstream media, it was a celebration of innovation. But for Wall Street private equity firms, it was a green light. SpaceX proved a critical hypothesis: everyday retail investors and the passive index funds tied to their 401ks are entirely willing to absorb astronomical valuations based purely on future promises. And that is exactly what the venture capital world needed to see. Because right now, the titans of the AI revolution, companies like OpenAI and Anthropic, are actively positioning themselves for the public markets. They have filed confidentially with the SEC, preparing their own historic IPOs. But they aren't just going public to share their profits with you. They're going public because the private credit markets are running out of money to keep their servers turned on. Before we look at the trap, we have to acknowledge the reality. Artificial intelligence is not a fake technology. It is not the 17th century tulip mania, and it is not a hollow cryptocurrency scam. Institutions like Morgan and even the Federal Reserve have explicitly pointed out that the AI sector is generating real, historic enterprise revenue. But revenue is only half of the mathematical equation. The other half is the physical cost of computing power. You cannot run a sentient-level AI on a laptop. You need data centers the size of small cities. You need dedicated nuclear power grids. You need billions of microchips. Between 2025 and the end of 2026, the 5 largest tech hyperscalers will spend over $1 trillion just on infrastructure. Data center debt financing skyrocketed from $15 billion in 2024 to well over $125 billion in 2025. This entire ecosystem is currently being propped up by high-yield debt and opaque, circular financing deals where chip makers essentially buy equity in their own clients just to inflate the numbers. But the physical cost of these data centers isn't even the darkest part of the math. To understand why this debt is so toxic, you have to look at how a growing slice of it is being created. It's a mechanism Wall Street calls circular financing. Here is the verified timeline. In September 2025, NVIDIA announced a letter of intent for up to $100 billion in progressive investment into OpenAI, tied to a massive chip deployment. By February 2026, amid reported internal doubts at NVIDIA, that plan was scrapped and replaced with a leaner $30 billion direct equity stake alongside separate, binding contracts locking OpenAI into buying NVIDIA's next generation of chips. OpenAI gets to broadcast a soaring valuation, the kind that makes a $1 trillion IPO look inevitable. NVIDIA gets equity upside, plus a client locked into buying its hardware for years to come. Both companies look fundamentally stronger on paper. Real money from real outside investors is certainly still flowing into this industry. But a growing slice of the capital fueling these mega valuations never actually leaves the loop. It just moves in a circle and gets counted twice. And here's the part that should really worry you. NVIDIA's own securities filings warned, months before the deal even closed, that it wasn't guaranteed at all. If the company writing the checks is hedging its own bet in a legal filing, why shouldn't you? We have seen this exact architecture before. In the late 1990s, it was called vendor financing, telecom giants lending their own customers the money to buy their own equipment. It was one of the central mechanisms that turned the dot-com boom into the dot-com collapse. It's a house of cards that only stays standing as long as the music never stops. You don't have to take my word for it. Just days ago, on June 28th, the Bank for International Settlements, the central bank to the world's central banks, issued a dire warning. They stated that the current AI exuberance risks ending in a prolonged investment slump that could shatter financial markets. The BIS drew a direct parallel to the dot-com crash of the late 1990s. A genuine technological breakthrough that attracted capital far in excess of what commercial returns could justify. The private credit lenders know this. The venture capitalists sitting on hundreds of billions in unrealized tech gains know this. The debt is becoming too heavy for the private sector to carry. So they have to transfer the risk, and that brings us to the mechanism of the mega IPO. When an AI-backed giant moves toward the public markets, a hidden war breaks out among the gatekeepers of your wealth. Early venture capitalists face strict lockup periods. They can't dump their shares on day one. But once those lockups expire, there's a mechanism waiting to absorb what they sell: passive index replication. In June 2026, the gatekeepers of the S&P 500 saw this coming. Despite SpaceX's staggering $2 trillion valuation, the S&P refused to bend its rules, blocking the company for lacking sustained profitability. They built a wall, actively shielding retail savers from an unprofitable, cash-burning valuation. But the Nasdaq did not build the same wall. The Nasdaq 100 has no profitability test just 15 trading days before a mega listing is fast-tracked in. Bypass that filter, and every passive ETF and retirement fund tracking the index becomes structurally required to buy in. No questions asked about cash flow, no questions asked about debt. Bloomberg estimates SpaceX alone triggered $14 billion in forced passive inflows. OpenAI and Anthropic are positioned to pull in billions more the moment they list. The system isn't broken. It's fractured. One index builds a wall. Another opens the floodgates. The artificial intelligence revolution will survive the coming capital squeeze. But if your retirement strategy relies on blind passive tracking through that open gate, the plumbing of the market means your savings are what's waiting on the other side. Stay vigilant. Subscribe to look past the noise, and I'll see you in the next breakdown.